Hello, and welcome to Mastering Finance with Dean Tellone. I'm Dean Tellone, and I'm excited to bring you episode 10, titled The Role of Private Mortgage Lending in Today's Market. In this episode, we're diving into the world of private mortgage lending, what it is, why it's becoming more popular, and how it impacts different people. We'll explore how private mortgages differ from traditional bank loans, why some borrowers, like real estate investors, self-employed business owners, or everyday folks with unique situations, might choose private lenders, and what benefits and risks come with this route. I'll also share real-world examples of how private lending has grown in recent years, discuss market trends, including new regulations, investor involvement, and fintech platforms, and give you some actionable tips, both for borrowers considering a private loan and for investors thinking about funding one. My goal is to keep it conversational, clear, and useful for everyone, whether you're a real estate professional, a high net worth individual, or just someone looking for alternatives in financing. So, let's get started and demystify private mortgage lending in today's markets. Understanding private mortgage lending. First, what exactly is private mortgage lending? In simple terms, it means getting a home loan or real estate loan from a private individual or non-bank organization instead of from a traditional bank or credit union. These private lenders could be individual investors, groups of investors, or specialized lending companies that use their own money or investors' money to fund mortgages. Because they're private, they don't operate under the same framework as big banks. This has some important implications. Flexible criteria. Traditional banks have strict guidelines. They heavily scrutinize your credit score, income, debt ratios, and they have to follow regulatory standards. Private lenders, on the other hand, have more flexibility. They often focus more on the value of the property and the overall potential of the deal rather than just your W-2 income or perfect credit. For example, a bank might reject a loan because your income is hard to verify or your credit score is a bit low. A private lender might still approve it if they believe the property is a good asset and you have a reasonable plan. In fact, many private mortgage loans, sometimes called hard money loans in real estate investing, are based on the collateral, the property, often considering its future value as well. Unlike banks that lend on the current appraised value, a private lender might lend based on the property's after repair value, ARV, meaning they'll consider what the property could be worth after renovations or improvements. This opens the door to financing projects that conventional lenders would never touch. Speed and simplicity. Because private lenders aren't bogged down by the same bureaucracy and regulations, the loan approval process can be much faster and more streamlined. If you've ever gotten a traditional mortgage, you know it can take weeks or even months of paperwork and waiting. Private mortgage loans can often be approved and funded in a matter of days to a couple of weeks. I've seen cases where a private lender gave a borrower the green light in 7 to 10 days, whereas a bank might have taken a month or more to even decide. This speed is crucial in certain situations, like buying at a real estate auction or when you need to close a deal quickly. The process is generally more straightforward. There's usually less red tape, fewer hoops to jump through, and often a more personal case-by-case evaluation of your loan application. In fact, private lenders are not required to follow all the same federal lending regulations that banks do. For instance, some provisions of the Dodd-Frank Act in the U.S., which means less paperwork for the borrower. However, and this is important, that flexibility comes with trade-offs, which we'll discuss shortly. Higher costs and shorter terms. Now, a big difference. Private mortgages typically cost more. Private lenders take on more risk by being flexible and fast, so they charge higher interest rates and fees to compensate for that risk. How much higher? It varies, but it's not uncommon to see private mortgage interest rates anywhere from the high single digits to low double digits. For example, around 8% to 12% or even more, whereas conventional mortgages might be around, say, 5 to 7% in the same environment. Also, private loans usually are short-term, often 1 to 3 years. Term length is common. They're often interest-only loans with a balloon payment at the end. This means you might just pay interest each month, which keeps monthly payments lower, and then pay off the whole principal, the balloon, when the term is up. Why such short terms? Because these loans are often meant to be temporary financing, a bridge to get the borrower over a hurdle or to finance a quick project. The idea is usually that the borrower will improve their situation, repair the property, improve their credit or income documentation, etc., and then refinance into a normal mortgage from a bank or sell the property before the private loan comes due. In summary, private mortgage lending involves a trade-off. You get speed and flexibility that you can't get from banks, but you'll pay more for it and you can't keep the loan forever. It's not a 30-year fixed mortgage, it's more of a short-term solution. Now that we know what private mortgage lending is, let's talk about why people use it. Who are the borrowers turning to private lenders, and what motivates them to take this route despite the higher costs? Why borrowers choose private lenders? You might be wondering, if private loans are more expensive, why would someone choose them over a bank loan? There are actually plenty of real-world scenarios where a private mortgage can be the best or only option. Let's go through some common reasons borrowers turn to private lenders. Borrowers with complex or non-traditional financial profiles. This is a big category. It includes folks like individuals with poor credit histories, self-employed entrepreneurs, gig economy workers, or people who had past financial hiccups. Traditional banks often have strict credit score cutoffs and require steady pay stubs or W-2 income. If you don't fit their mold, say your credit score is below the bank's requirement, or you run your own business and write off a lot of expenses, making your taxable income look low, you might get denied by the bank. Private lenders may be willing to work with these borrowers. They look at the bigger picture and can overlook a lower credit score or irregular income if the asset and overall story makes sense. For example, a self-employed person might have a volatile income that doesn't look good on paper, but they have a strong business and assets. A private lender could still give them a mortgage when a bank wouldn't. Similarly, someone who went through a foreclosure or bankruptcy some years back might still be in a waiting period for a conventional loan, but a private loan could bridge them into home ownership sooner, at a price, of course. In short, private lending fills a gap for borrowers who are creditworthy in alternative ways, but don't meet the cookie-cutter criteria of banks. Real estate investors and house flippers. Investors are probably the most frequent users of private mortgage lending. If you're a real estate investor, say you're looking to buy, fix, and flip a property, or you want to buy a rental property quickly, speed and agility are everything. The market moves fast. Waiting 45 plus days for a bank to approve and fund a loan could mean losing out on a lucrative deal. Private lenders cater to this need by providing fast funding. It's not unusual for a real estate investor to get funding in a week or two from a private or hard money lender. This speed lets investors jump on opportunities. Also, private lenders often finance properties that need significant renovation. A bank might refuse a mortgage on a house that is in disrepair or won't appraise well until fixes are made. Private money is frequently used to buy those fixer-uppers. The investor repairs the property, adds value, and either sells it or refinances it with a traditional loan later. In fact, private lending has become integral to the fix and flip industry. One industry analysis noted a 30% increase in loans to property flippers recently, driven by high demand for renovated homes. Investors also like the flexibility of terms like interest-only payments, so their monthly expenses stay low while they rehab a house. Simply put, if you're an investor, private loans offer speed, flexibility, and the ability to finance projects that conventional lenders won't touch, which can make the difference between snagging a great deal or missing it. Self-employed business owners or high net worth individuals with unique finances. I want to single out this group even further. It's ironic, but sometimes even wealthy individuals or successful business owners get turned down by banks for mortgages. Why? Banks have very specific documentation requirements. If you have income that's irregular or comes from various sources, like business profits, investments, etc., the bank's underwriting might label you high risk because it doesn't fit their narrow criteria. I've met business owners who have plenty of assets and cash flow, yet couldn't get a bank mortgage due to, say, lack of 2 years of consistent income documentation. These borrowers might choose a private lender who can make a common sense judgment on their ability to repay, looking at their overall financial picture rather than just a tax return. Additionally, high net worth individuals might use private lenders for convenience or speed, or even to avoid having to liquidate investments on short notice. For instance, imagine a scenario where a buyer wants to purchase a new property, but their money is tied up in stocks or a business deal that won't cash out for a few months. They could use a short-term private loan to purchase the property now, quickly, and then pay it off when their funds become available. The bottom line here is that private loans can cater to complex financial situations in a way traditional lenders often won't. Unique or non-conventional properties. It's not just who you are as a borrower, but sometimes what you're trying to finance. Banks have strict criteria about properties too. They typically want standard houses in good condition. If you're trying to get a mortgage on a very unique property, say a log cabin, a tiny home, a mixed-use property, or land with a partially built structure, or a home that needs a lot of TLC, a bank might reject it. Private lenders are often more willing to finance properties that are outside the box. They might see the potential after improvements, as I mentioned with ARV. For example, if a house is a fixer-upper that won't qualify for a bank loan in its current state, a private lender might step in, lend based on the property's future value after rehab, and enable the purchase and renovation. Similarly, for land deals or construction loans, private lending might be an avenue if the bank isn't comfortable until certain milestones are met. Essentially, when the property itself doesn't meet bank standards, private money can be the bridge to get that property into a financeable condition. Need for speed or bridge financing. Sometimes the issue is timing. You might actually qualify for a bank loan, but not quickly enough. Perhaps you found your dream home or a prime investment, but you need to close in 2 weeks. Or maybe you're in a situation where you bought a new house, but haven't sold your old one yet. You need a short-term bridge loan to carry the mortgage for a few months. Private lenders can shine in these situations because they can act fast and offer short-term loans. For instance, if you're facing foreclosure or another urgent deadline, a private mortgage lender might rescue the situation by lending money within days, giving you time to regroup or refinance later. Speed is one of the top reasons borrowers choose private lending. Private lenders often approve loans in days instead of the many weeks a bank requires. In competitive real estate markets, being able to close quickly can even make your offer more attractive to a seller. I've seen buyers use a private loan to win a bidding war, essentially advertising a fast close with cash from a private lender, then later refinancing with a traditional mortgage. It's a strategic move. Keep in mind, though, that this convenience has a cost, higher interest. But if the deal is profitable or the need is critical, borrowers are willing to pay for that speed and certainty of funding. Simplified approval, less red tape. Another reason borrowers might prefer private lending is simply to avoid the headache of traditional mortgage bureaucracy. Let's face it, getting a loan from a bank means tons of paperwork and sometimes invasive questions and long waits. Private lending tends to be more relationship-driven and pragmatic. The regulatory freedom private lenders have can make the borrowing experience smoother. Private lenders in many cases are not bound by all the strict federal rules, for example, certain ability to repay rules that banks must follow. That doesn't mean it's a Wild West with no rules. There are still laws and contracts, but it does mean if a private lender trusts that you and the property make sense, they can say yes, when a regulated bank would have to say no. Less red tape and a more customized review of your situation can be very appealing to borrowers who feel frustrated by the one-size-fits-all bank process. Borrowers often comment on the more personal aspect of private loans. You might actually talk directly to the decision maker, the private investor or small company owner, rather than just dealing with a checklist from an underwriter. Those are the main motivations. Basically, private mortgage lending exists to fill the gaps left by traditional lenders. It serves people who are underserved by banks, which can include everyday home buyers in certain situations, not just investors. In fact, while a large chunk of private mortgage loans go to real estate investors, a significant share also goes to regular homeowners and buyers. Recent data shows roughly 60% of private residential loans are issued to investors, and about 40% go to owner-occupiers and first-time home buyers. So this is a tool used across the spectrum. If you're someone who doesn't tick all the boxes for a bank loan or you need money quickly for a real estate opportunity, private lending might be an avenue to consider. However, going this route isn't a decision to take lightly. We need to weigh the benefits and risks for everyone involved. Let's break those down from both the borrower's point of view and the investor's point of view. Benefits and risks of private mortgage lending. Private mortgage lending has its advantages and disadvantages, and it's important to see both sides of the coin. I'll first talk about what this means for borrowers, the people taking the loans, and then for investors or lenders, the people providing the money. For borrowers, home buyers, or real estate borrowers, the benefits are largely what we've already touched on. The biggest benefit is access to credit and speed. If a bank loan isn't available to you because of your credit, income type, or time constraints, a private mortgage can be a lifesaver that provides financing when and how you need it. It can enable you to buy a home or investment property you otherwise couldn't. Another benefit is flexibility. Private lenders might structure the loan in ways that suit your needs. For example, offering interest-only payments for a while, or not requiring mortgage insurance even at a higher loan-to-value or financing a property that needs rehab. This flexibility can make certain deals possible. Also, for real estate investors, private loans can be strategic tools. They can finance a flip or allow a purchase without contingencies, which might let you negotiate a better price on a property for a quick sale. In some cases, private lenders might not require as much documentation or may overlook past issues, which can reduce stress for a borrower who knows they have the collateral to back the loan, but maybe not the paper credentials a bank wants. In short, from the borrower's perspective, the allure of private lending is getting approved quickly for a loan that is tailored to your situation when no one else will lend you the money. However, the risks and downsides for borrowers are significant. Cost is number one. As we noted, private mortgages come with higher interest rates and often additional fees, points paid up front, origination fees, etc. This means borrowing this way is expensive. You have to make sure the opportunity or need truly justifies paying, say, 9% interest instead of 5%, or paying a couple of points in fees. If it's a short-term loan, maybe that cost is manageable. But if something goes wrong and you end up needing the loan longer than expected, it can really add up. Another risk is the short-term nature. You might only have 12 months before that big balloon payment is due. If you're not ready to pay off or refinance by then, for example, if you plan to refinance but still can't qualify for a bank loan a year later, or the home hasn't sold yet, you could be in trouble. Private lenders are generally not meant to renew loans over and over, though some might extend if you pay additional fees. You could face foreclosure or be forced to sell the property if you can't exit the private loan on time. So, borrowers have to be very mindful of that exit strategy risk. Another risk, because the private lending market is less regulated, borrowers don't have the same protections they might have with a traditional mortgage. There's no government agency looking over a private lender's shoulder as closely, and things like interest rates can be quite high, though there are usually usury laws to prevent truly exorbitant rates depending on jurisdiction. The onus is on you, the borrower, to do due diligence. Make sure the lender is reputable and the terms are fair. There have been cases of predatory lending in the private space, like loans designed to fail so the lender can take the property. That's not the norm with reputable private lenders, but it's a potential danger in any less regulated market. In fact, borrowers must carefully evaluate private lenders and fully understand the loan terms. It's wise to have an attorney review the contract, because once you sign, you're obligated, and a misunderstanding could hurt you. So, in summary, borrowers get flexibility and access, but they pay more and take on the risk of a short fuse on the loan. It's a tool that must be used wisely and usually as a short-term fix, not a permanent solution. For investors, private lenders, or those investing in these loans, now let's switch hats and look at the perspective of the lender, which could be an individual investor, a fund, or anyone providing the capital for private mortgages. Why lend money in this space? The potential benefits for investors are financial and strategic. The most obvious is higher returns. Private mortgage lending can yield returns significantly above those of many other fixed income investments. It's not unusual for private lenders to earn on the order of 8% to 12% interest on their loans, which in a low interest rate environment, or compared to bonds or savings accounts, is very attractive. Investors earn these high rates, and often there are origination fees or points that also go to the lender or broker, boosting the return. Secondly, the loans are secured by real estate, which is a tangible asset. Many investors like the idea of a secured loan. If the borrower defaults, the lender has the right to foreclose and take the property as collateral. That can be seen as a safety net, though it's not foolproof, as we'll discuss in risks. Compared to something unsecured, like a personal loan or a credit card debt, a mortgage on a property is considered less risky because there's an asset backing it. Another benefit is shorter investment horizon. Many private lenders like that, these loans turn over in a year or two. They're not tying up their money for 30 years at a fixed low rate. Instead, they get it back relatively quickly, if all goes well, which they can then reinvest. This also helps them adjust to market changes. For example, if rates go up, they can redeploy money at higher rates, rather than being locked into a long, low-interest loan. There's also an element of diversification and control. Wealthy individuals or family offices sometimes allocate a portion of their portfolio to private mortgages to diversify away from stocks or traditional bonds and into real estate-backed assets. They may feel they understand local real estate and can make safer bets lending on properties in their area. Additionally, private lending can be mutually beneficial. Investors often report satisfaction in helping borrowers who were turned away by banks, essentially creating win-win deals. And let's not forget, in recent years, a lot of institutional investors and funds have entered this space, providing capital to private lending companies or creating mortgage investment funds. This influx of capital has professionalized parts of the industry, making it easier for investors to participate through platforms or funds and for borrowers to find money. It's become a recognized asset class known as private debt or private credit. For investors who don't want to originate loans themselves, there are funds and marketplace platforms where they can invest in fractional pieces of loans. Technology has made it possible to invest in a diversified pool of private mortgages with relatively low effort, capturing those high yields. On the flip side, investors face risks in private mortgage lending, as with any high-yield investment. Default risk is the big one. The borrower could fail to pay back the loan. If that happens, as the lender, you might have to go through the legal foreclosure process to seize the property. Foreclosure can be costly and time-consuming, and while you're doing that, your money is tied up and not earning a return, and you might be paying legal fees, property taxes, etc. There's also the risk that when you finally take the property and sell it, you might not recover the full amount you lent, especially if the real estate market has declined or if the property deteriorated. Private lenders try to mitigate that by lending at lower loan-to-value ratios, often 65% or 70% of the property value, or even less, which gives a cushion. But markets can be unpredictable. Another risk is that, unlike a bank, which might have a whole department for underwriting and collections, individual private lenders may not have the infrastructure to thoroughly vet borrowers or handle defaults. If you're an individual investor lending your money, you need to perform due diligence on who you're lending to and on the property's value. Any mistakes in evaluating the deal could lead to losses. Additionally, liquidity risk. Private mortgage investments are not easily sold or traded. If you suddenly need your cash, you can't just press a button and sell the loan, not without potentially steep discounts, or if you arrange that possibility beforehand. You're generally in it until the borrower pays off. Regulatory and legal risk is another factor. While private lenders operate with more freedom, there are still laws, usury laws capping interest in some states, licensing requirements, especially if you make a habit of lending, consumer protection laws if you're lending to someone on their primary residence, etc. An investor has to be careful to comply with applicable laws. Otherwise, there could be legal consequences. There's also the risk of economic downturns. In a recession or housing crash, private loans could suffer higher default rates, and property values could drop, impacting investors significantly. Statistics historically show that private loans have had varied performance. Interestingly, some recent data suggests default rates on private residential loans have been competitive with traditional loans. One report noted an approximately 2.5% default rate for private loans versus approximately 4% for traditional in a certain period, possibly due to careful lending practices. But that can change if the market turns. Lastly, operational risk. If you're doing this on your own, you have to handle paperwork and legal filings, like recording the mortgage or deed of trust properly. Any oversight could jeopardize your security interest. Investors can mitigate some of these risks by using professional services, lawyers to draft documents, loan servicing companies to collect payments, etc. But those are costs to consider. Essentially, investors trade stability for yield. You can earn more than you would in a bank product, but you have to accept illiquidity, complexity, and the chance of borrower default. That's why I always say, if you're considering becoming a private lender, go in with your eyes open, do your homework, and don't lend money you can't afford to tie up or potentially lose if worst comes to worst. So, for both borrowers and investors, private mortgage lending is a double-edged sword. Borrowers get opportunity and flexibility, but at a cost and risk if they can't exit the loan. Investors get high returns and diversification, but face the risk of defaults and need to be very hands-on and cautious. Now, armed with this understanding, let's look at some real-world examples and trends in the private mortgage market to see how this is playing out in today's economy. Industry examples and market trends. Private mortgage lending has evolved a lot over time, and its role in the market tends to expand and contract based on larger economic conditions. Let's explore some notable trends and examples that illustrate how private lending fits into the big picture today. Filling the gap during tight credit cycles. One clear pattern we see is that when banks tighten their lending standards, private lending steps up and grows. A historical example of this is the period after the 2008 financial crisis. Following the crisis, regulators imposed stricter rules on banks, which was necessary to prevent risky lending. But it also meant a lot of would-be borrowers could no longer qualify for traditional mortgages. Even as the economy recovered, banks remained cautious and had to adhere to new, stringent requirements, like higher credit score minimums and tough stress tests for borrowers. During that time, private lenders started to capture more of the market by lending to those that banks left behind. For instance, in Canada, after regulators introduced strict mortgage stress tests in 2018, private mortgage lending surged. Data from the Canada Mortgage and Housing Corporation, CMHC, showed that the share of new mortgages extended by private lenders increased from about 5.3% in 2021 to around 8% by the first quarter of 2023. That's a significant jump in just a couple of years. In the same period, the big banks' share of mortgages dropped from 62% to about 54%. In other words, private and alternative lenders stepped in to fill the void as traditional lenders pulled back. It's estimated that private and non-bank lenders now account for roughly 10 to 12% of the mortgage market in Canada as of 2023, whereas a decade ago, their share was much smaller. We see similar trends in the US and other countries. Whenever there's a credit crunch or banks get more conservative due to economic uncertainty or new regulations, private money becomes more prominent. For example, when the COVID-19 pandemic hit in 2020, a lot of banks tightened lending, and anecdotal reports suggested private hard money lenders got busier as real estate investors still needed financing. The general point is, private lending is counter-cyclical in some ways. It becomes a crucial lifeline when traditional credit is hard to get. This has cemented its role as an alternative financing channel that can support the real estate market when the usual channels are constrained. Booming in hot markets. On the flip side, private lending also thrives in hot real estate markets, not just tight credit markets. When housing markets are booming, say in a city or region where properties are selling fast and often above asking price, having quick access to capital is a competitive advantage. Buyers and investors have turned to private lenders to get bridge loans or short-term financing to act quickly. For example, in recent years, we saw extremely competitive markets in places like parts of California, Texas, or Florida. Some buyers would use a private loan or a cash-like offer through a lender to close a deal in a matter of days, then refinance later with a cheaper bank loan. Real estate investors in hot markets also used private financing to snap up properties for redevelopment or flipping, because any delay could mean losing the deal to someone else. Private lenders often advertise that they can close in a matter of days, not weeks, and that's a huge selling point in a hot market. This trend was also evident during periods of rising home prices when people owned lots of equity. Rather than sell their home, some homeowners might take a private second mortgage to pull out cash quickly for another purchase or investment, betting that they could pay it off when they refinance or sell later. One real-world example: in Ontario, Canada's largest housing market, by 2021, about 11% of homeowners had turned to private lenders for borrowing, totaling over $22 billion in loans, as they found it increasingly difficult to get what they needed from banks in a frenzied market. Even though that's a specific locale, it highlights a broader point. In hot markets or unique situations, private loans give flexibility and speed that many participants are willing to pay for. It's a tool that, when used well, can generate profit for investors or help buyers secure a home when otherwise they'd be edged out. Growth in volume and mainstream acceptance. Overall, private mortgage lending has grown from a niche segment to a more mainstream part of the finance industry in the past decade or two. To give you a sense of scale, one analysis found that the volume of private residential lending transactions in the U.S. has been growing about 25% per year for the past 5 years, reaching an estimated $65 billion in loan volume in 2023. Those are big numbers, indicating that this isn't just happening on the fringes. It's a substantial market now. We also see more institutional involvement. Investment banks, hedge funds, and mortgage REITs have put money into private mortgage funds or even started their own lending operations to capture that high-yield business. Even some traditional banks, interestingly, have found ways to participate, such as providing funding lines to private lending companies or acquiring stakes in alternative lenders. There's a bit of a convergence happening where the line between bank and private lender is blurring in some cases. Banks want a piece of that profitable pie, while private lenders seek more capital. Technology and platforms. A major trend propelling the growth of private lending is the rise of financial technology platforms. Just as we've seen with peer-to-peer lending for personal loans, the mortgage world has its online platforms now. These platforms act as marketplaces connecting private investors with borrowers, often focusing on specific niches like fix and flip loans, rental property loans, or crowdfunding for real estate projects. Examples include platforms like Lending Home, now called Kiavi, Fundrise, Ground Floor, and others, which have facilitated billions of dollars in loans online. They streamline the process with user-friendly applications, data-driven risk assessments, and sometimes even allow retail investors to fund portions of loans. For borrowers, this means instead of needing to know a local private lender or go through a broker, they can apply online and potentially get matched with funding from investors nationwide. For investors, it means you can invest in real estate debt from your computer, choosing loans that meet your criteria without personally handling the origination logistics. One report highlighted that such digital platforms and data analytics have improved efficiency in private lending, even reducing default rates by leveraging better risk modeling. Technology is making private lending more accessible and transparent, which likely contributes to more people and money flowing into this space. It's no longer purely an old school relationship business. Now you have tech-driven companies revolutionizing how deals are sourced and underwritten. Regulation and oversight. With growth and greater visibility comes more attention from regulators. Private mortgage lending used to operate in the shadows to some extent, but now regulators and policymakers are asking how to ensure consumers are protected without stifling this valuable source of credit. In some regions, new regulations or guidelines have been introduced. For instance, certain U.S. states like California and Texas have worked on regulations specifically aimed at private or hard money lenders, requiring licensing, setting caps on certain fees, or mandating disclosures to borrowers. These rules are often designed to prevent predatory practices and ensure that borrowers are not being exploited while still allowing the private loan market to function. There's a balance to strike. Regulators don't want to choke off the flow of capital that helps people, but they also don't want unchecked lending with no consumer protection. As a result, compliance costs for private lenders have been rising in recent years as they adapt to these regulations. Many reputable private lenders now operate almost like banks in miniature, with compliance departments and strict processes, especially if they deal with owner-occupied home loans. It's worth noting that if a private lender is making loans to consumers, like someone's primary home mortgage, they may fall under certain federal laws in the U.S. like Truth in Lending Act and others. So the Wild West days are fading. The sector is maturing. This trend is good news for borrowers in that it weeds out some bad actors and brings more transparency. However, too much regulation could also reduce the flexibility of private lending. It's a bit of a tug of war. As of today's market, I'd say private lending is still more flexible than banks by far, but it's becoming more structured than it used to be. Investor involvement and securitization. Another trend is that after private loans are made, they sometimes get packaged and sold, similar to how bank mortgages are sold. There's a developing secondary market for certain private mortgage loans, especially those on residential investment properties. We've seen an increase in mortgage funds and mortgage investment corporations, MICs, particularly in Canada, where multiple investors pool money to fund private mortgages. In fact, the mortgage investment corporation model in Canada has grown tremendously. The market for MICs more than tripled between 2007 and 2021. In the U.S., some private lenders securitize their loans, bundle them, and sell as bonds to investors. This brings more capital into the system and can lower costs for borrowers due to competition. It's indicative of private mortgages becoming a recognized asset class that large financial players participate in, not just local lenders. All these trends point to one thing: private mortgage lending is playing a larger and more established role in today's market than ever before. It's responsive to market conditions, stepping in when banks step out. It's fueled by both necessity and opportunity, serving unmet borrower needs and offering juicy yields for investors. And it's evolving with technology and regulation. For someone considering engaging with private mortgages, whether borrowing or investing, it's important to understand these trends because they affect the availability, cost, and safety of private loans. Now, with all that context in mind, I want to share some actionable insights and tips. If you're a borrower thinking about a private mortgage, what should you do? And if you're an investor thinking about dipping your toes into private lending, what are some best practices? Let's get into those. Actionable insights for borrowers and investors. Whether you're wearing the borrower hat or the investor hat, preparation and knowledge are key. I'm going to break down actionable tips into two parts. One for borrowers considering private mortgage loans, and one for investors considering funding private mortgages. These tips will help you make informed decisions and avoid common pitfalls in the private lending space. Tips for borrowers considering a private mortgage loan. Assess all your options. First, before jumping into a private loan, make sure it's truly the best or only solution. Have you exhausted conventional financing possibilities? Sometimes working with a mortgage broker or financial advisor can help uncover creative solutions with traditional lenders that you might have missed. Because private loans are costly, they should usually be a plan B or a short-term bridge, not the first resort. That said, if time is of the essence or your situation just won't pass a bank's criteria, then a private loan could be the right call. Just go in knowing why you're choosing it over alternatives. In short, use a private mortgage when you need to, not because it's easy money. Research and verify the lender's reputation. Not all private lenders are equal. There are great ethical lenders and there are predatory ones. Do your homework on any lender you're considering. Check if they are licensed. Some jurisdictions require private mortgage lenders or brokers to have licenses. Look for reviews or ask for references from past clients. If you're working through a mortgage broker or platform, ask how they vet their lenders. It's perfectly okay to ask a private lender about their experience and track record with loans. A reputable private lender should be transparent about terms and willing to answer your questions. Due diligence works both ways. Just as a lender will check out a borrower, you should check out the lender. Remember, this is a financial transaction. You want to ensure you're dealing with someone fair and professional. I always advise people, if something feels off, like excessively high fees, or pressure to sign quickly, or terms that seem too good to be true, trust your gut and maybe seek a second opinion. Taking the time to find a trustworthy lender can save you a lot of trouble down the road. Understand the terms completely. This might sound obvious, but read every line of the loan agreement, or have a legal professional read it. Private mortgage terms can be very different from a standard bank mortgage. Key things to look at: interest rate and how it's calculated, any fees, origination fees, broker fees, appraisal fees, etc., the term, length of the loan, whether it's interest only or amortizing, and importantly, any prepayment penalties or extensions. Many private loans charge an upfront fee and also a fee if you want to extend the loan beyond the initial term. Also, check if there's a prepayment penalty if you pay the loan off early. Some private loans might have a minimum interest guarantee, e.g., you must pay at least 3 months of interest, even if you pay it off sooner. Make sure you know when the full payoff is due and what happens if you're late. Is there a grace period? Do interest rates jump if you go past the term? Also, clarify who holds things like the insurance. You usually still need homeowners insurance and to list the lender as an interested party, and taxes. Some lenders might want you to pay property taxes into an escrow, others leave it to you. Because the private mortgage market is less standardized, every lender might do things a bit differently, so don't assume anything. Get it in writing. If you are unsure about any clause, ask. It might be worth hiring a real estate attorney for an hour or two to review the contract and point out any red flags or points to negotiate. Remember, once you sign, you're bound to those terms. Knowing exactly what you're agreeing to will prevent nasty surprises later. Plan your exit strategy from day one. I can't emphasize this enough. Have a clear plan for how you will pay off or refinance the private mortgage before you take it. Private loans are meant to be short-term. Ask yourself, what's my strategy to get out of this loan? Maybe you plan to improve your credit and refinance with a bank in 12 months. Or you plan to renovate and sell the property. Or you're waiting for a big bonus or investment cash out to pay it off. Whatever it is, be realistic about the timeline. If you think you'll need longer than the initial term, discuss that with the lender up front. Some might offer an option to extend for an extra fee, which is good to know in advance. Also, consider contingency plans. What if the house doesn't sell as quickly as expected? Or what if interest rates change and refinancing is harder? It's wise to build in some cushion. For example, if you think you'll be ready to refinance in 6 months, maybe get a 12-month loan just in case. Because these loans are usually temporary bridges, you need a bridge to somewhere. Know where that is and how you'll get there. If your exit strategy is to refinance with a traditional lender, start preparing for that almost immediately. Work on your credit, have your financial documents in order, etc. If your plan is to sell the property, start marketing it well before the loan term is up. Don't get caught scrambling at the last minute. A private lender will expect you to stick to the agreed timeline, and if you can't, you may have to pay more fees, or in worst case, face foreclosure. So treat the end game as seriously as the initial loan itself. Budget for higher payments and costs. With higher interest rates, your monthly payments, if amortized, or your accrual of interest, if interest only, will be larger than a conventional loan of the same size. Make sure you can handle the cash flow. For example, if you're borrowing on an investment property, factor the interest payments into your project's budget and carrying costs. If it's an owner-occupied situation, ensure your monthly budget can handle the interest only or interest plus some principal payments you'll need to make. Also, set aside money for the upfront fees and closing costs of the private loan. They can be a bit steep, commonly 1 to 3% of the loan amount in fees, on top of interest. Sometimes these fees can be wrapped into the loan, but that means you're borrowing more. Also remember that since the term is short, you might be facing another set of closing costs within a year or two if you refinance with a bank. In essence, go in with eyes open about the costs. Run the numbers. If using this expensive money still results in a profitable outcome for your project or solves your problem affordably, great. But if the math is thin, be careful. For homeowners using a private loan to buy a house, think about the worst-case scenario. If you couldn't refinance in time, could you afford the higher rate for longer, or would you be forced to sell? It's prudent to have a little emergency fund or cushion when dealing with private loans, because life happens and you want to have a buffer if your timeline stretches. By budgeting conservatively, you'll reduce stress and be prepared for the true cost of the loan. Consult a qualified advisor. Finally, as a borrower, it's often worth talking to a financial advisor or an experienced mortgage broker when considering a private mortgage. They can help you weigh the pros and cons objectively. A good advisor will ensure you've considered how this loan fits into your overall financial picture and future plans. For instance, they can help plan the refinance or sale strategy with you, or advise on how much of your portfolio to leverage. Since private loans aren't typical, an expert opinion can be invaluable to avoid mistakes. Additionally, if you're dealing with legal paperwork or unusual terms, an attorney's advice can protect you. Don't be afraid to spend a bit on professional guidance. When you're dealing with something as significant as your home or a major investment, getting it right is worth every penny. The overarching tip for borrowers is be informed and be prepared. If you do that, a private mortgage can be a powerful tool rather than a risky gamble. Tips for investors: exploring private mortgage lending opportunities. Educate yourself and start small. If you're new to private mortgage investing, it's crucial to understand the business before diving in. This isn't as passive as, say, buying a mutual fund. Even if you invest through a platform, you should grasp how and why these loans work. Start by learning from others. There are communities and associations, like the American Association of Private Lenders, where you can read articles or attend conferences or webinars to get the lay of the land. It's also a good idea to network with experienced private lenders. Maybe there's a local real estate investor group you can join. Often those circles include people who do private lending or hard money lending. Hearing their experiences, the good, bad, and ugly, will give you perspective. When you're ready to begin, consider starting with smaller loan amounts or participating via a reputable platform or fund. For example, you might invest a modest sum in a crowdfunding platform that lets you fund a fraction of different loans. This way, you get a feel for the process and performance without putting a huge amount of capital at risk. As you gain confidence and knowledge, you can gradually increase your involvement. Also, learn the legal basics. Know what a promissory note is, a mortgage or deed of trust, how foreclosure works in your state, judicial versus non-judicial, and any licensing laws. Some states require a license to originate loans above a certain number per year, even for private individuals. You'll want to be aware of that. The more you educate yourself up front, the fewer costly mistakes you'll make later. In summary, treat this like a business and get some mentorship or education. Then crawl before you walk before you run in terms of investment size. Perform thorough due diligence on every loan. When acting as a lender, you effectively become the underwriter that a bank would normally be. So do your homework on each deal. This means carefully evaluating the borrower, the property, and the loan terms. For the borrower, look at their credit history, their experience. If they're an investor, have they done successful projects before? Their income sources or exit plan, and their character. Because private lending is often more asset-focused, you might not require a high credit score, but you still want to know if they have a history of defaults or financial irresponsibility. Sometimes a face-to-face meeting or a conversation can be telling. Since you might be dealing with individuals, trust and communication matter. For the property, don't just take someone's word on value. Require a credible appraisal or valuation. Check the market comps yourself too. If it's a fix and flip scenario, evaluate the rehab plan. Are the cost estimates reasonable? Is the after repair value they expect realistic? Also, consider the market conditions in that area. Is it a liquid market where you could resell the property fairly quickly if you had to foreclose? Look at the loan to value (LTV) ratio. Most prudent private lenders stick to around 65 to 70% LTV or even less, meaning the borrower has some significant skin in the game, equity. That way, if the market softens, there's a buffer before you'd be underwater. For example, if a property is worth $100,000, lending no more than $65,000 to $70,000 on it is a common rule of thumb. That cushion is your safety net. For the terms, ensure you structure the loan in a way that protects you. This includes having proper insurance. You should be listed as mortgagee on the borrower's property insurance, requiring the borrower to maintain the property, maybe even requiring interest reserves for a few months of payments if you think that's needed. Double-check all legal documents. It's worth having a lawyer draft or at least review your loan documents to make sure your lien will be enforceable and you have all the clauses you need, like default remedies, coverage of legal fees, etc. If this sounds like a lot, remember a single bad loan can wipe out the profits of many good ones, so diligence is key. Trust but verify every critical piece of information the borrower provides. If you're investing through a platform or fund, a lot of this diligence might be done by their team. Still, read their prospectus or FAQs to know their criteria. At the end of the day, whether direct or indirect, you want to ensure each loan meets sound criteria. As an investor, be as picky and analytical as a bank would, if not more, since you might not have government insurance or other backstops. Diversify your private lending portfolio. The old saying, "Don't put all your eggs in one basket," applies here too. If you have, say, $500,000 to invest, you probably don't want to lend it all on one single loan to one borrower on one property. That's high concentration risk. Instead, you might do 10 loans of $50,000 each, or join a fund that spreads your money over many loans. Diversification helps because even if one deal goes south and you incur losses, others should still perform, balancing it out. A lot of private lenders are individuals who might do a handful of loans per year. Try to vary the type of projects and borrowers if you can. Maybe one loan is a residential fix and flip in one city, another is a small commercial property bridge loan in another area, etc. Geographic diversification can protect you from local market downturns, and diversification among borrower types can reduce risk too. If you don't have the bandwidth to find multiple deals, again, consider investing via a pool or fund where diversification is built in. Also, be cautious not to overextend your capital. Keep some reserves for unexpected events. For example, if a borrower stops paying and you have to fund a foreclosure or property maintenance, that money has to come from somewhere, likely you. So don't lend every dollar you have. Maintain an emergency fund. Many seasoned private lenders will tell you that you make your money on the underwriting and the spread, but you keep your money by managing risk and being patient. Private lending returns of 8 to 12% can be very attractive. But remember, those returns come with corresponding risk. By diversifying, you aim to smooth out the bumps. Think of yourself like a mini bank. Banks make thousands of loans knowing a few will default. But as long as most are good and they manage exposure, they still profit. You should approach it similarly on your scale. Use proper legal and servicing channels. Once you decide to fund a loan, make sure all the legal documentation is correctly handled. This typically means having a promissory note, the IOU from the borrower, and a mortgage or deed of trust recorded against the property, depending on your state's system, to secure your interest. Engage a real estate attorney or a title company to handle the closing, just as a bank would. They will ensure you get a title insurance policy. Yes, lenders can get title insurance to protect against any title issues, and that your lien is properly recorded in first position, or second, if that's what you're doing, behind any prior loans as agreed. Don't do casual off-the-record deals. Always document everything. Also, consider using a loan servicer. This is a company that, for a small fee, will handle collecting payments, keeping track of balances, and sending statements. This can make your life easier and provides a bit of buffer between you and the borrower for the day-to-day matters. A servicer will also handle escrow for insurance, NOSH, taxes if needed, and can initiate default notices if someone is late. This professional touch can keep things formal and clear. If you choose to service the loan yourself, be very organized and consistent. Send monthly statements or reminders to the borrower. Keep meticulous records of every payment and know the procedures if a payment is missed, like sending a notice of default after X days, etc., according to your contract and local law. Also, ensure the borrower's insurance is current and lists you so that if something happens, fire, etc., you are notified and your interest is protected in the payout. In case of any default, act promptly. The longer you wait, the harder it may be to recover. This is where having a lawyer ready to step in is good. If a borrower doesn't cure a default, you'll want to start the foreclosure process or whatever remedy is available. It might sound harsh, but remember, this is business and your capital is on the line. Being disciplined and professional in managing the loan protects both you and your investment. It's also a good idea to stay in periodic communication with the borrower, especially on longer-term loans, just to ensure things are going as planned, or to get early warning if they anticipate any trouble. Maybe you can work something out, like giving a bit more time for a higher fee, which is often a win-win compared to a messy foreclosure. Prepare for the worst-case scenario. A smart private lender always asks, "What will I do if this borrower doesn't pay?" and has an answer ready. That means before you fund the loan, you should be mentally and financially prepared to take over the property or enforce the loan if needed. Ask yourself, am I willing to own this property if it comes to that? Do I have the resources or partners to manage or liquidate it? In many cases, lenders who foreclose will quickly sell the property, possibly at an auction or through a real estate agent, to get their money back. Consider lining up a real estate agent or an investor contact who could help dispose of the property if you had to take it back. Also, factor in legal costs and time. Foreclosure laws vary. In some states, you could foreclose in a couple of months. In others, it might take a year or more if the courts are involved. Understand that process beforehand. This ties back to diligence. Prefer lending in jurisdictions where you know you can enforce relatively efficiently if needed. Being prepared for the worst doesn't mean it will happen. In fact, most loans, if underwritten well, will perform fine. But having a plan for default will make you a more confident and secure lender. Some lenders even outline in the contract what happens in default clearly. All loans do. But some private lenders negotiate things like deed in lieu of foreclosure clauses to speed up resolution. Whether or not you have special clauses, just be ready. It might also be wise to keep a financial cushion reserved to cover a few months of non-payment or the costs of foreclosure. Essentially, hope for the best, but plan for the worst. If you never have to use those plans, fantastic. If you do, you'll be glad you had a strategy in place rather than scrambling. This mindset also helps you not to panic if a hiccup occurs. You'll treat it as part of the plan rather than a nightmare. Stay informed and adapt. The private lending market can change with economic conditions. As an investor, keep an eye on market trends, interest rates, and regulations. For example, if mainstream mortgage rates go up or down significantly, it will affect what borrowers are willing to pay in private rates too. If home prices start dropping in your area, you might tighten your LTVs or pause new lending until things stabilize. Also, be aware of any legal changes. Perhaps your state introduces a new requirement for lenders or a new consumer protection rule. Staying compliant is crucial. Networking with other lenders or joining industry groups can help you stay updated on these developments. Additionally, consider the role of technology. There are now tools and platforms that can help with sourcing deals, analyzing risk. Some fintech companies offer risk analytics to lenders and managing loans. Don't hesitate to leverage these resources to improve your operation. Private lending, when done right, can be both profitable and rewarding. You're helping fund real projects and people's goals, but it's an active investment. If you ever feel it's too much to manage directly, you can look into more passive options like investing in a private mortgage fund run by professionals. Just do similar due diligence on the fund managers. The key takeaway for investors is be diligent, be cautious, and treat it professionally. If you do, you can navigate the risks and reap the benefits of this asset class. Both borrowers and investors should remember the common theme. Knowledge and advice are your friends. Don't operate in isolation. Consult with mortgage professionals, financial advisors, or legal experts whenever you're unsure. Private mortgage lending has its complexities, but with careful planning and prudent action, it can be navigated successfully. As we wrap up episode 10, let's recap and reflect on what we've covered. Private mortgage lending plays a unique and increasingly important role in today's financial landscape. It serves as a flexible financing tool that can bridge gaps where traditional banking falls short. Whether it's helping a self-employed entrepreneur buy a home, enabling a real estate investor to swiftly close on a deal, or providing an option for a borrower with time-sensitive or complex needs. We learned that private lenders, unlike banks, can tailor loans based on the property and individual situation rather than rigid formulas, offering speed and customization. This can make seemingly impossible deals possible. At the same time, we underscored that this flexibility comes at a higher cost and risk. Private mortgage interest rates are higher and terms are shorter, so borrowers must use them wisely and have a clear plan to transition out of these loans. From the borrower's perspective, private loans are a double-edged sword, a lifeline when you need one, but not a tool to misuse or take lightly. For investors, we saw that private lending can yield attractive returns and diversification, but it requires due diligence, solid risk management, and often hands-on involvement to do it right. Real-world examples showed how private lending tends to expand in times or places where banks retrench. For instance, stepping in during tight credit periods like post-2008 or in red-hot property markets where quick funding is king. The market trends indicate that private lending is not just a fringe activity. It has grown into a significant sector influenced by technology, with online platforms enabling more people to participate on both sides of the equation. Regulation is catching up to ensure fairness, which is a positive sign of a maturing industry. In essence, private mortgage lending has evolved from a niche, hard money corner of real estate to a mainstream alternative financing option integral to many real estate transactions today. For those listening who are real estate professionals or business owners, understanding private lending is essential. It might offer solutions for your clients or for your own deals that you won't find at a bank. High net worth individuals might see it as an investment avenue, while everyday borrowers might find comfort that if a bank says no, it's not the end of the road. There may be other avenues to explore. No matter which group you belong to, the key is to approach private mortgages with informed caution. Use the actionable insights we discussed. If you're a borrower, make sure to vet your lender and have an exit strategy. If you're an investor, be thorough in evaluating deals and protect your downside. One overarching piece of advice bears repeating. Make informed financing decisions and consult a qualified financial advisor or professional before diving into something like a private mortgage. This space can be immensely helpful and profitable, but it can also be perilous if navigated incorrectly. An advisor can help weigh the pros and cons in the context of your personal financial situation or business goals, ensuring that whatever step you take fits into a sound plan. Thank you for joining me in this deep dive into private mortgage lending. I hope you found this discussion engaging and enlightening. As always, my aim is to break down complex financial topics into clear, actionable insights so you can make the best decisions for your financial future. If you found today's episode helpful, please subscribe to Mastering Finance with me, Dean Tellone, and consider sharing this episode with anyone who might benefit from understanding how private mortgages work. We have many more exciting topics ahead to help you master your finances. Until next time, stay informed, stay smart about your money, and remember, every financial decision is a step toward mastering your future. Make those steps count. Thank you for listening, and see you in the next episode.